Financial derivatives. This is a term that we often hear in the news channels, on the financial magazines, newspapers, and this is one of the financial product which is often criticized, and yet there is a fine following. We can't imagine the modern financial world, institutional investors, businesses, the fund houses to function as smoothly without financial derivatives. Though we have several big critics of this, yet we don't see this being stopped. With the time, the size of the financial derivatives and its usage has only grown. Financial derivatives are alleged to be one of the factor and the cause behind 2008 crisis. Also, CDS, one of the financial derivatives, is blamed for the fall of two Italian banks around 2008 during the subprime crisis. Warren Buffett, the legendary investor, described financial derivative as the financial weapon of mass destruction. So, despite having so much of the criticism and the fear factor behind this, we only see this growing. Right now, if we take some number, the notional value of the swaps around the world is almost $700 trillion. Similarly, if we look at the size of options, the future, and the forwards, they all goes in almost hundreds of $trillion. So it is just growing despite all the criticism. So let's examine with me and understand what are the basics of the financial derivatives and how it functions, what are the derivatives, why they are used for, where one can buy and sell, and we'll talk through all these aspects in the sessions today. And I also promise you there will be more sessions on such topics like financial derivatives and various different types of derivatives in subsequent sessions on the YouTube channel. So keep watching the videos, and I will share some interesting insight on the capital market. So my name is Nidhish Singh. I'm member of ACCA, CISI, Institute of Directors. I'm diploma in IFRS, and also I'm a PhD researcher in private equity. I'm working as a vice president and head of transformation at JP Morgan. And today I'm going to walk you through the basics of financial derivatives. So let's see what it is. So first thing first, there are four main types of the derivatives, which is future, forward, swap, and options. And we'll go through some key features of these products, and there will be separate sessions for each one of them as well. So what is a derivative? Derivative as a term, can we say that it is an instrument that derives the value from its underlying. So on its own, derivative do not have a value. It gets its value from the underlying product. So for example, I can tell you that, okay, this pen has been signed off maybe the US president or Indian prime minister. And one day, this can be worth in millions. So some of you would be willing to buy this. So today, if I sell it for, say, $5, in a couple of years' time, or maybe in a decade time, it could be in $1 million. So what is really increasing its worth and the value? The signature of some of the legendary politicians or the leaders of the business, etc. So the underlying value is not the pen itself. Pen is just a derivative. Underlying asset is the signature of a well-known person. So the pen is deriving its value from the underlying asset, which is the signature of some celebrity. And this is how the value of derivatives goes up or down. So it derives its value from the underlying asset. Another example could be, say, I promise you on a contract to give you 10 stocks of Tesla for, say, $500. And if it is trading, say, today 500, we can just agree on the contract that I will sell you this Tesla stock only for $500, even 2 years later. 2 years down the line, suppose that Tesla stock is $800. Now, that agreement that I signed to you saying that I can sell you Tesla stock at the rate of 500, it has an increment, an inherent value. There is a value in this agreement, because now you have the right to buy those Tesla stock from me at a much lower price. It's a valuable contract for you, and the contract itself has a massive value. But where it is coming from? It is coming from the fact that I have promised you to give you a stock at a lower price, which is the inherent value is coming from the stock of Tesla, not from the agreement. Agreement is just a derivative. The underlying is the Tesla stock, which is giving the value to this entire agreement and the entire contract. So derivative is something that derives its value from an underlying contract, underlying product, underlying signature, or anything which is underlying part of this. Yeah, and that's why the name is derivative. So of course, the derivative can be financial or non-financial as well. If I give you a football signed by a champion or a coach, football coach, that can have higher value in future as the time passes. A signed football of a legendary footballer can increase in value with time. And this football is deriving its value from the signature. So in this case, it is a non-financial derivative. But on the same time, if I give you a contract signed by me on a legal stamp paper that I will sell you Tesla stock at a favorable price, or maybe at 500, even 10 years from now, then the same contract becomes a financial derivative. So that's the difference between the financial and non-financial derivatives. Now, let's look at how the companies and derivative market works. So here, markets are used to transfer goods, services, and funds or risk. And derivative can become a medium to transfer the risk or even protect against the risk. So company A do not want to have certain risk, and it wants to transfer its risk to somebody else, maybe a seller of derivative, or which can be a company. So company B will be getting the risk from company A, and in return, it might earn some premium, or which is similar to insurance premium as well. So if you want to transfer your risk to someone, you need to give insurance premium, and that company will bear the risk for the exchange of the premium. Again, of course, it might turn that the company A never needed that contract, or company B just got the money or the insurance premium without having any future obligation later on. But this is how the liabilities are transferred from company A to company B. A live example could be that a company A, which is sitting in US and has some invoice pending from its vendor. So company A is expecting that it will get 100 million US dollar in 90 days. The payment will be from a company based in Australia. Now, if Australian dollar becomes stronger, in that case, US company will gain. It will be in an advantageous position because Australian dollar is stronger and it is going to get the payment in the Australian dollar, and it will translate a higher amount back home. But imagine that Australian dollar is becoming weaker in future. In that case, company A will start to lose, because when the Australian dollar will translate to the US dollar, it will be less than expected value of 100 million. that delta, because that can translate into maybe 98 million only, and the company A will bear a loss of 2 million because of FX. We know foreign exchange market is quite volatile and it keeps moving. So in 90 days, company A might lose $2 million. Now what to do? Company A will prefer to go into a contract, into an agreement. And that agreement would be that it will say, all right, so we want to just exchange USD and AUD. So in that contract, the company A will say, okay, I'm expecting an Australian dollar in 90 days. So company A will say, I would like to sell AUD, which is currently trading at, say, 1 USD is equal to 2 AUD. So at this rate, I want to sell the Australian dollar when it is paid by the client. So US company in future will get, say, if the foreign exchange moves and the Australian dollar becomes more expensive, then the company will anyway sell all the Australian dollar and will translate into USD. In case the US dollar becomes stronger, still there will be exchange between the two parties. So the other party is called counterparty. And the counterparty will have the liability actually to buy all the AUD from company A at the rate prevailing today. So basically the simple way to look at this is, in future, 90 days from now, whatever the movement happens in the market, no one is concerned. The company A and the counterparty both would have locked the price prevailing today. So if what happens is Australian dollar becomes stronger, of course, it might be beneficial for company A, but as per the contract, company A still has to sell the Australian dollar as of the rate agreed in the contract. In case Australian dollar becomes weaker, and that is not a good news for company A, but company A will be able to sell the Australian dollar at the rate agreed earlier. That means company A do not have to worry anymore. They know that the rate has been fixed already, and whenever the client pays equivalent to, say, 100 million, they can sell that Australian dollar in the market and can generate expected $100 million from the market. Because whatever the rate moves, whether the Australian dollar or US dollar goes down or up, as per the contract, the rate has been frozen already for next 90 days. This is a great way to get rid of the headaches caused by the foreign exchange movements. Now, if we were to translate the same thing for any other scenario, we can do that. Say, for example, if I were to give you a contract saying that I will sell you 10 grams of gold at, say, 50,000 rupees, right? So I can sign you an agreement that I will sell you 10 grams of gold for 50,000, and in case the gold becomes 60,000 per 10 gram, you are gaining, because you can buy the gold 10K cheaper from me. And that's the benefit of going into future forward or options or swaps, because it will help you lock the rates based on your requirements. So this is how many derivatives work. There are multiple derivatives, derivatives upon derivatives, and it's a quite a complex world, no doubt. But this is the best way to understand and get the grasp of the basics. Moving on to next interesting part of this. So what is derivative? We talked about counterparty A. So the party A here, the company, and the company, as we discussed earlier, want to hedge against the USD/AUD movements. So what they do, they will exchange the risk with each other, and there is a counterparty B, because if we go into a contract with the counterparty B, basically both of them are agreeing to certain commitment. They are, both of the parties are agreeing that the rate will be fixed, and it can go in that way. It can benefit this or this. Either of the party can be benefited based on the contract. Because if today I agree with someone to buy or sell certain commodity at a given price, and I have to do that in 90 days, so it can go against and for my interest. So it can go both way. Hence, in a way, both party is protecting themselves against the risk. So I think that I need 1 kg gold 90 days from now, and if I have any business which requires consumption of gold, then I would go into a contract with a goldsmith saying that, okay, can you please sell me in 90 days 1 kg gold for 50 lakhs. Imagine if the gold goes up 60 lakhs, I can still buy from the goldsmith at 50 lakhs, which is beneficial for me. I'm saving 10 lakhs per kg. But what if the gold goes down? It becomes 40 lakhs per kg. I'm losing, because I have to still buy, depending on the type of contract. Some contracts do not force me to buy, that is called option. But generally, if I'm going into future and forwards, I still have to buy 1 kg of gold from the same goldsmith at the same price that I agreed earlier. Now that price is higher than the market. I could have bought in the market at a lower price. This means I'm also exposed to certain risk, but the rate is agreed earlier. That's why I'm kind of betting in a situation whereby I can gain and I can lose both. So risk is shared between the two parties. Both parties have the risk and reward both logged in terms of an agreement, and those kind of agreement can be on the exchange, or it could be just between the two parties. We will talk about that later. But this is how the two counterparties are bound in a legal agreement called derivative. So that is agreement called derivative contract. So the agreement I talked about, that is signed whereby the contract details are mentioned. 1, rates of exchange are mentioned, like what should be the FX rate, how much gold I'm going to buy at what rate, all those are mentioned. So the quantity is also mentioned in that. Quantity, rates, contact details, all the details are provided in this derivative contracts. Also time is important, right? So time is also important. So these are the part of the contract, and of course the underlying asset. Here we are talking about gold. So gold is the underlying asset. If I try to fix foreign currency rate, then FX or maybe currency, that is underlying asset, or it could be anything else as well in the financial market. Today we have heard a lot of news about Bitcoin. If anyone saying that, okay, they can go into a contract with me selling a Bitcoin at the given rate in today's, that will be great stuff, because there is a speculation it can go up. So if someone agrees to sell Bitcoin at today's rate, maybe in a year from now, that will be a fantastic contract. So any such contracts are called derivative, and underlying asset in this case will be Bitcoin. Right now it is trading at around 55K. Imagine somebody would have got into the contract maybe 3 years earlier to buy Bitcoin at the rate maybe only 1K. Then Imagine the benefit. People can buy based on the contract at 1,000 only, whereas it is trading in market at 55,000 per Bitcoin. So that is the nature of the derivative products, and this is how it works. Components of derivatives. So what derivative consists of? What are the key elements to look at the derivatives? One is underlying contract that we talked about, counterparty with long and short positions, and an expiration or maturity date. So I have talked about the underlying asset, which is gold. Maybe it could be a bond, it could be foreign currency, or a Bitcoin, or any such cryptocurrency. Secondly, counterparties with long and short positions. So it definitely requires a counterparty, because party A has to go into the contract with party B. It's just like marriage. You need two people, right? That's how, even in the derivative, you need two people, or at least two parties, to go into the contract. So counterparties are required, and there is a long and short position. So let's understand what is long and short position. So it's not like long means 5 meter long, or short means 1 meter short. Long means when someone bet to buy an asset as per the contract, or when someone want to purchase in the future any particular asset, then it is called going long. When the contract is such that one wants to sell, then it's called a short contract. So if I agree in an agreement that I want to sell gold 6 months from now at the rate of 45,000, I'm a short. I'm selling short. I'm a short counterparty. So that's the meaning of long and short. And finally, expiration or maturity date, because any agreement has to have a particular maturity date or expiration date. Of course, there are different type of legality and consequences as well of the different expiration date. That is especially relevant in option, because in Europe versus American options, the maturity dates have different implications. Plus, in the bond world, maturity date is also giving rise to more risk, basically, and it is the one of the factor for the duration risk. However, every contract has to have expiration or maturity date, so that is an essential part of any derivative contract. Next is underlying assets. So what is the underlying asset of a derivative contract? So as we discussed, it can be stock like Tesla, it can be a bond. So someone can promise me to sell a bond at a lower or higher price, or maybe in today's prevailing price 6 months from now. So the underlying asset can be a bond as well. It's not just a stock, it's not just Bitcoin or currency, it can be a bond. Any financial instrument, any financial asset can be part of the or can become the underlying asset of the derivative. Currencies, we discussed about that. We can fix a rate, foreign exchange rate, based on today's prevailing price or any such price, to exchange some amount of cash. So that would be the currency. Commodities, gold or oil or any such item can be commodity as well. So that can act as an underlying asset of the derivative. And market indices. So I can have a derivative on stock exchange index, or maybe Nifty or US stock exchange. So those index can also act like a underlying asset, because if the say index goes up by 10%, the long in the contract will gain, because the rate would have been fixed at the lower price, at the lower index. But if the index goes down, then the long will lose. So it can be on the index as well. And finally, interest rates. We can definitely see it has a great value. Those who have mortgages, they would like to fix their interest rate exposures, or any other loan holder, they would like to minimize the interest rate risk. So derivative can protect from interest rate movements and volatility as well. Next, in a derivative contract, one party is often described as holding a long position, another one is a short. We have talked about this. So if I'm saying that I want to buy gold, as per the agreement given on today's date, I'm a long position holder. So I'm counterparty A, who have to benefit when the value of the value of the underlying asset goes up, and counterparty B will benefit, somebody who is short, when the value of the underlying asset goes down, because then they can sell at a higher price. So this is how the short and long positions are described and clearly mentioned in the agreement as well. So how do we get it settled? The settlement of derivatives. So we have talked about our 90-day contract for gold or Bitcoin. So how essentially it settles? It can settle in both ways, physical as well as the cash settlement. So the physical settlement is when, based on the agreement between me, you remember my earlier example, I had a agreement with the goldsmith to buy 1 kg of gold from him or her. So 90 days from now, when my manufacturing units need 1 kg of gold, I will ask the goldsmith to deliver to me 1 kg of gold at the price prevailing today. So I will hand over a 50 lakh rupees in a bag and will say that, okay, give me the 1 kg gold after weighing accurately. So that is a physical settlement. Or if my foreign currency broker or counterparty gives me the actual USD or euro at the end of the period based on the agreement, that is a physical also settlement. Or there could be a cash settlement whereby we just look at the gain and losses. So let's take an example. In case of cash settlement, right? So going back to the same example as the gold. So we calculated the contract was 1 kg, rate was 50K. Then we realized 90 days from now, so 90 days later, the gold is at 60K, and this is all for 10 gram, say. Okay, so 50 kg, 10 gram earlier. Now it is 60 kg, 60,000 per 10 gram. Now I can clearly see that the contract was for 1 kg, right? So for 1 kg, I'm gaining how much? 10K per 10 gram. So for 1 kg, I would gain 10K times 100 in order to become 1 kg, and that's why I will have 1000K, so almost 1 million INR. So I am in a gain. I have a profit of 1 million INR. So I would say, Mr. Goldsmith, since he's in a different town or cities, I said that there's no need to give me gold. I don't need it. You just, even though I use that in my manufacturing unit, I would give him the privilege to transfer me that additional profit of 1 million rupees that I'm in a gain position. That goldsmith can just transfer that amount in my bank account and it can settle in cash. So it can settle in cash rather than delivering the underlying asset. I don't need the asset physically. And in the world which is smart, everything is digital, we would prefer to get the cash to the extent of the unrealized gain. So this is how it settles in case of cash. Finally, the derivatives that we have talked about, they are of two types: exchange traded and over the counter. also called OTC. So let's first understand the exchange traded ones. So exchange traded is the one which is still there. So when the derivatives that we talked about, future, forward, options, etc., when they are on the exchange, they are called exchange traded. And why they are kept on exchange is when we have party A and B that we had referred earlier. So counterparty A, that person is happy because he's making gain. Now counterparty B, so and maybe he is the goldsmith and he is losing. He clearly sees that in 90 days or maybe in few days he has to or she has to transfer me 1 million rupees. So the counterparty is not at all happy. Oh, it looks like crying. Yeah. So counterparty B is not happy. And then we are in two different towns. I'm in town A and the counterparty is in town B, maybe separated by 5,000 kilometers. Or so, maybe 2,000. But whatever, it is a massive physical differences. We have never seen each other. We don't know much each other. And though the agreement was signed, but counterparty B is not happy. And now he's planning not to pay me that $1 million. This is called counterparty risk. Counterparty risk. In such situation, we need to have someone intermediary. Somebody has to be as an intermediary. Which will be exchange in some cases. So the agreement that we are going into, so one part of the agreement will become exchange. So between me and exchange, there will be one agreement. And there'll be another agreement between basically as a clearing party, there'll be agreement between the exchange and counterparty B. So of course, the agreement terms and condition will be agreed by the two party, but it will be sold through exchange. The agreement will be on the exchange and exchange will take care of the gain and loss between the two party, and exchange will ensure that no party actually defaults, because exchange will take care of the gain or loss of each party. So when exchange comes in between the two, that is called exchange traded derivatives. However, when there is no exchange and we are just dealing between the two people, this is called over the counter, because two independent, two natural person can go into a contract and agree certain terms and conditions to pay to each other in case of gain or loss in the future. That kind of agreement, that kind of derivatives are called over the counter derivatives. Of course, exchange traded is safer. It is a more legally properly drafted contract. It's more standard contract. It is legally enforceable. It is safe, and hence it provides more liquidity as well. It is, since it is considered safer, more and more people trust exchange traded derivatives, and that's why it is higher in volume as well. So that is the story about exchange traded versus over the counter. And finally comes a very, very interesting topic: hedging versus speculation. When many funds started, the aim was not to speculate. The objective of using the derivative was to hedge against any abnormal or undesirable market movement. Later on, it became the vehicle of speculation as well. Why speculation? Because if, for example, I do not own a Tesla stock, if I don't own a Tesla stock and still I sell to someone, So A sells Tesla to party B without owning it, and then can plan to buy it later in the future and return to the broker. This is one of the example of speculation. And in the same manner, sometimes people go into derivative. So A might go into a derivative contract with a counterparty B, saying that, all right, so I will sell you gold at the rate of 20K. Why? Because this gentleman, A, he thinks that gold is going to crash. Market will go up, and since when the market goes up, generally gold goes down. So gold price is going to crash. So from 50K, it will just come down to 20K. And I can sell that at 20K. Now, whether he owns or not, he might be just thinking that gold can even go further down, so he can still sell at 20K, because in his mind, gold might be going at, maybe at that point of time, it might be selling at 15K. So he will say, oh, I can sell it in 20K. So that is a pure speculation, because here there might not be enough research conducted. It could be just based on certain gut feeling, or the person might be getting some premium for selling that contract. In the option, basically, those who sell the right to someone else to buy or sell the commodity like gold, that is called option contract. And in option contract, for selling such a right, people get the premium, people earn the premium. And sometimes in the greed and just because of the over speculation, people sell such contract, which is completely risky and do not have enough data to back it up. And ultimately, when the gold prices are still at higher rate, people have to oblige the counterparty by selling the gold at 20K. Imagine when the market is selling gold for 50K and one has to sell at 20K, it will be a massive loss. But that is the nature of speculation. So when someone speculates, they can incur massive loss, and there might not be enough even gold in the stock. So the person has to buy from the market and then sell it at a lower price. And here, there's nothing being hedged. It's a pure guesswork. There's no transactions to protect against. There's no real need to write such options that counterparty A can sell the gold at a lower price. So this is a typical speculation. Speculation is dangerous, because here the person do not have any gold reserve to sell as well. They have to buy from the market and sell at a lower price. So buying higher and selling a lower, that could be the result of a speculation. On the other hand, we have talked about the currency risk. If party A thinks that they are going to get 1 million AUD in future, and AUD price can go down, then A has a genuine business concern to protect. So what A will do? A will go into a contract with B and will say that, okay, A will sell AUD at today's price. And with this contract, when A can sell the AUD to B at today's price, A can protect its a profit, and it can also lock the foreign exchange rate today itself, and then there will be no fear of foreign currency movements because of that transactions. So if A wants to lock the foreign exchange rate today, it can do so by going into a future or forward. Here, this is a genuine business case. A knows what they are doing. A has a business reason to go into a contract. So that is a hedging. However, when it is just a pure guess, when there is no business risk to hedge, there is no business risk to protect, when someone think that market is going in a particular direction and they can benefit from this, that's called speculation. Okay, so in such situation, there is a massive upside potential as well as a downside potential as well. One of the examples that we can see nowadays of speculation is GameStop. GameStop also did the same thing. They sold short. They sold the actually Melvin Fund on behalf. Basically, they sold the GameStop shares in the market after borrowing from the brokers, thinking that the price will crash and then they will buy back at the crash price, at the lower price. And it didn't happen. The price actually went up. So that was an example of speculation as well. So that is the difference between the speculation and hedging. And derivatives are also used in both ways, and speculation becomes quite risky in that sense. And that's why Warren Buffett and such critics says that financial derivatives are financial weapon of mass destruction. And then it seems to have some genuine logic. So with this, we move to the final slide of the session. So what are the common derivative contracts? As we have listed at the start, there are two key types of the contracts, like a contingent claim, whereby the buyer of the options, they do not have a liability, they just have an asset. They do not have to fulfill any obligation, they just have a right to buy certain underlying asset at a favorable price, or maybe sell at a favorable price. So that is called contingent claim. However, when the both sides have the obligation and responsibility, right? So the difference between the options and other derivatives and the difference between contingent claim and forward commitments are the type of responsibility and rights. So in options, one has to pay certain premium, like insurance contract, and have only rights, no obligation, no responsibilities. But in case of the forward commitments, which is forward future swaps, both parties have same rights and same obligations. Because if I go into a, as I mentioned earlier, if I go into a forward or future agreement or swap agreement with Goldsmith, and I promise that, okay, I will buy in 90 days the gold of 10 gram gold in 50,000, I have to. Whether the gold goes up or down, I still have to buy the gold at the same price, at the same rate. In that case, I can make a gain or I can make a loss. So I'm completely exposed to the market movement. So in that case, that is called forward commitment. I can make a loss or gain both. Derivative becomes a zero-sum game for me, ultimately. And I am exposed to both sides of movements. But in case of option, I'm much safer. But yes, of course, at the start itself, I have to pay a premium to the counterparty, because all I have is rights. I have no obligations. So the counterparty has to be compensated to giving me that exclusive right. So with this, the basic of the derivative session ends here. Of course, you can continue watching the videos, and there will be more updates and the discussion on the derivative contracts, various other capital market products such as bonds, equity, stock market. So stay tuned to the channel, and time to time we will float more such videos, and leave your comments in the queries.